Welcome to all of you Shiksha 360. And today basically we have to discuss some of the doubts basically by the students, as I have posted some of the questions basically in the group for the practice purpose, and some students basically have doubt in that. So let's start our discussion on the basis of that. So the first question basically which this student basically has doubt on this question. Suppose a dealer quotes all in cost for a generic swap. Clear, basically suppose a dealer quotes all in cost for a generic swap at 8%. Clear, suppose a dealer quotes basically all in cost for a generic swap at 8%. That is the interest rate. We can say that like against the 6 months LIBOR. That is time is equal to 6 months. If the notional principal amount of swap that is 5 lakh. Clear? So that is basically we can say that principal here it is to be 5 lakh. So calculate the semi-annual fixed payment. Clear? So basically we have to calculate the semi-annual fixed payment. Clear? So in these types of question, clear? Basically in these types of question, basically that is basically they can say that basically semi-annual fixed payment. That is interest. How much they have to pay? That is semi-annually. That is half yearly. Clear? So half yearly basically how much interest basically they have to pay. Clear? How much interest basically they have to pay it there. Okay. So simply in these types of question, clear, you can assume basically either basically total number of days. We know that this is 365 days, clear. But in most of the questions, clear, as per the option, you will go with the basically 360 days. Clear, we can assume also 360 days in a year. Clear, so you can go through basically with both. Clear, most of the time basically you will find the answer basically with using 360 days. Clear, basically with using 360 days. Clear, as it leads to the little bit simpler calculation. Clear, simple calculation. So let's discuss here regarding that. So simple interest, simple formula, that is semi-annual fixed payment. So that is simple interest formula. Basically just we have to put a P into R into T upon 100. So principal here that is 5 lakh. Rate here that is 8%, 8 upon 100. Time that is 180 days, 6 months that is 180 days upon 360. Just take this one. 1, 2, 1, 4, 1, 25, 1, 2. So it comes out to be 20,000. Clear? So it comes out to be 20,000. So option number A is the answer here. Clear? Option number A is the answer here. Now any query, any doubt regarding this question? Clear? Just it is simply straightforward thing basically they have asked in the examination and we have to go with that. Clear? And basically we have to go with that. If anyone has any doubt, any query regarding the same, please ask fast. Okay. The simple we have to use, that is semi-annual fixed payment. That is generic swap at 8% against 6 months. That is time period they have given 6 months. That is 180 days. LIBOR flat. Clear? Notional principal amount of swap that is 5 lakh. Okay. So any doubt, any query in this question, please ask. Otherwise, basically we will move to the next question. Okay. Now move to the next question. So this question, that is basically in this question, there is nothing, anything to be calculation. Clear? This question, that is, it is a straightforward line. They have taken basically from the book. Let's discuss regarding that. A future contract, clear, basically a future contract of USD 1 million, clear, basically a future contract of USD 1 million for 1 year. Clear? Basically a future contract of USD 1 million for 1 year on a treasury bond. Clear? Basically a future contract of USD 1 million for 1 year basically on a treasury bond, trades at dash. Clear? Trades at dash if the expected increase rate. Clear? Trades at dash basically if the expected interest rate at the end of the period is 4%. Clear? That is futures contracts of USD 1 million basically for 1 year on a treasury bond trades at which rate? Clear? That is if the expected interest rate at the end of the period. Clear? If the expected interest rate basically at the end of the period is 4%. Clear? So what will be the answer? The correct answer basically for this question, it is to be option number B, that is 96. Clear? 96. Clear? So let's discuss what is the thing here. Clear? So basically this is the thing basically which they have present or available in the book. Directly I will take from that. Clear? So interest rate futures are the contracts written on fixed income securities. Clear? So interest rate futures basically are the contracts written on fixed income securities. Example like treasury bills, bonds, etc. of specified size. Contracts written on treasury bills. Clear? Basically contracts written on treasury bills basically trade in short-term interest rates. Clear? Contracts basically written on treasury bills basically trade in short-term interest rates, while contracts on treasury bonds or corporate bonds deal in medium and long-term interest rates. Clear? So please remember that basically contracts written basically on treasury bills, that is short-term. Clear? That is basically short-term interest rates, while contracts basically written on treasury bonds or corporate bonds. Clear? It is to basically medium or long term. Further, interest rate futures. Clear? Basically interest rate futures are the most popular instrument. Clear? Basically interest rate futures are the most popular instruments to hedge the interest rate risk. Clear? So interest rate futures basically are the most popular instrument basically to hedge the interest rate risk. Treasury bills, basically treasury bills, that is basically interest free, because in that basically interest is to be fixed. Okay? So treasury bills being risk free instruments basically indicate movements in market rate of interest. Clear? Basically indicates movements in market rate of interest. So the treasury bills basically are traded at a discount. The discount basically being equal to the interest rate for the period. Clear? So basically the treasury bills are basically traded at a discount. And what is the discount? That is the discount basically being equal to interest rate basically for the period. Like this question, because it is a treasury bond. So basically a future contract, sorry, a future contract of USD 1 million. Clear? A future contract of USD 1 million basically for 1 year. Clear? A future contract of USD 1 million for 1 year on a treasury bond. Clear? Basically future contract of USD 1 million for 1 year basically on a treasury bond trades at 96. Clear? Basically where it trades at 96 if the expected interest rate basically at the end of the period is 4%. Clear? So a future contract rate. Clear? Basically a future contract rate, a future contract of USD 1 million. Clear? A future contract of USD 1 million for 1 year. Clear? Basically a future contract of USD 1 million basically for 1 year on a treasury bond trades at 96. Clear? Basically trades at 96 if the expected interest rate. Clear? Basically trades at 96 if the expected interest rate basically at the end of the period basically it is 4%. Clear? So what is the price? That is basically 100 minus 4. Clear? So this is the discount that is equal to the interest rate, that is 100 minus 4, that is 96. That is the futures price. Clear? Similarly they are asking basically trades at which price? That is 96. Clear? If the expected interest rate basically at the end of the period basically it is to 4%. Clear? So 100 it is to 96. Clear? This is the assumption here. So basically the price of the contract basically fluctuates daily. Clear? The price of the contract basically fluctuates daily according to the perception of the interest rate basically for the residual maturity. Treasury bill futures are traded basically with the US treasury bills, and notes are underlying instruments, while euro dollar bonds are traded on the basis of the LIBOR. Clear? While euro dollar bonds are traded on the basis of LIBOR or interbank deposit rates outside USA. Okay? So this is the point basically just I want to discuss, that is straightforward. Clear? Sometimes basically student basically will think that basically this is a numerical type question. Clear? As such basically this is not a numerical type question. Clear? As such basically this is not a numerical type question anyway. Okay, now move to the next point. As yesterday, basically one student has doubts, sir, what is the meaning of the long position? Clear? So what is simply basically they are asking, what is long position? What is short position? What is open position? So we know that basically long, that is buy, short, that is sell. Okay, we have already discussed these things. Clear? Just I will discuss once again. Clear? Just definition so that basically you are able to understand. Clear? So long position, what is that basically? That is basically when any person, clear, basically buys anything. So that basically they will see that basically, sorry, long position, that is basically buy, so that basically they will get benefit basically in the upcoming time. Clear? So basically it refers to a long position. Basically it refers to a position. Clear? What is long position? Basically it refers to a position where, clear, it refers to a position basically where gains arise from a rise in the value of the underlying. Clear? Basically where gains arise basically from a rise in the value of a underlying. Clear? In the value of the underlying. That is the long position. Clear? So next one basically that is a short position. So what is the short position here? Clear? So next one basically that is what is the short position here. Short position, that is basically where we feel that basically in the upcoming time the value is going to be going down. So basically we will face loss. Clear? So basically it is better to sell at that time. Clear? So it is better basically to sell at that time. Basically that is the short position. So I will write here, refers to a position. It refers to a position where gains arise. Clear? Basically it refers to a position basically where gains arise from a decline in the value of the underlying. Clear? Basically where gains arise from the decline in the value of the underlying. Clear? Basically in the value of the underlying. Clear? Further basically it also refers to the sale of the security. Clear? Basically it also refers to the sale of the security, in which the, it also refers to the sale of the security basically in which the seller does not have a long position. Clear? In which the seller basically does not have a, clear, in which the seller does not have a long position. Clear? So third one basically that is the open position. Clear? So can anyone tell basically what is the open position? So what is open position? Basically it is the net difference. Clear? So basically it is the net difference between the, clear, it is a net difference basically between the amounts payable. Clear? It is the net difference basically between the amounts payable and amounts receivable. Clear? It is the net difference basically between the amounts payable and amounts receivable in a particular instrument or commodity. Clear? Basically in a particular instrument or commodity. Clear? So it is a net difference basically between the amounts payable and amounts payable basically in a particular instrument or commodity. Clear? So these are the some important things basically, important points basically which you will find directly in the examination. Clear? Directly in the examination. Clear? So one more point, that is basically many students basically have also asked regarding that, like what is basis risk? Clear? Like what is basis risk? Can anyone tell basically what is basis risk here? Clear? What is basis risk? Basically that is the risk that the interest rate, clear? Basically the risk basically that the interest rate of different, clear, the risk basically that the interest rate of different assets, liabilities, clear, the risk basically that the interest rate of different assets, liabilities and off balance sheet items, clear, and off balance sheet items basically may change, and off balance sheet items basically may change in different magnitude, clear. That is basically the risk that the interest rate of different assets, liabilities and off balance sheet items may change in different magnitude. It is to be termed as a basis risk, clear. It is to be termed as the basis risk, clear. So please remember that all these things that are very, very important basically for the examination point of view, clear, that are very, very important basically for the examination point of view, clear. Any query, any doubt basically what we have discussed today up to this much point? Please tell fast, clear. Please tell fast if anyone has any doubt, any query regarding that, clear. So these are some of the doubts basically has asked by basically 2 to 3 students, clear, regarding what we have covered till now, clear. So one point I will discuss with all of you, clear. So this is the basically Altman model. I think all of you have basically gone through the case study regarding that Altman's model, clear. So among the Altman model, clear. So can anyone tell basically what is Z? This Z is equal to how many x1 plus x2, 1.2 x1, next 2.4, sorry, 1.4 x2, 3.3 x3 plus 0.6 x4 plus x5, clear. So this is the Z. 1.2 x1 plus 1.4 x2 plus 3.3 x3 plus 0.6 x4 plus x5, clear. So here what is x1? Very, very important. X1 basically that is net working capital upon total assets ratio, clear. Net working capital upon total assets ratio. Second one basically what is x2? That is retained earning upon total asset ratio, clear. That is retained earning upon total asset ratio, clear. That is retained earning upon total asset ratio. Next one that is x3, earning before interest and taxes, clear. EBIT, clear. That is earning before interest and taxes upon total asset ratio. Fourth one that is x4, clear. So what is x4? That is MVE upon book value of long-term debt ratio, clear. Upon book value of, clear, MV that is basically market value of equity, clear. That is MVE basically that is market value of equity upon book value of long-term debt ratio, clear. Upon book value upon long-term debt ratio. Last one basically that is x5, that is sales upon total assets, clear. That is basically sales upon total assets, clear. So these are the different, that is basically under the Altman model. This one Z, 1.2 x1, 1.4 x2, 3.3 x3, 0.46x4 and plus x5. Clear? So you have to put all the values x1, x2, x3, x4, x5 here. Clear? So you have to put all the values here and try to solve the question. Clear? I have already discussed one case study on the basis of that. Clear? Along with 2 to 3 questions. Clear? Even in which I have discussed basically with all of you basically how to calculate all these things. Clear? Basically how to calculate all these things. Clear? How to calculate x1, x2, x3, x4, x5. Okay, so I request to all of you, please go through these things. And so what is this is overall basically as some of the doubts basically asked by some of the students I have taken here. Clear? So thanks to all of you for joining this session. Hope it is clear to all of you basically what we have discussed today.